The Situation Room was already tense before the phone even rang. Trump's trade advisors sat around the Oval Office desk as reports flooded in. China was offering to invest $1 trillion into the U.S. economy if Washington agreed to drop national security barriers on Chinese capital. Bloomberg first broke the number, citing sources close to ongoing talks in Madrid. The room went silent. $1 trillion from the world's largest economy, proposed not as aid or partnership, but as leverage. Officials immediately questioned the logic. Chinese investment into the U.S. had fallen to barely $2 billion in 2025, compared to $57 billion in 2016, according to Rhodium Group data cited by the Financial Times in July 2025. That's a collapse of over 95%, driven by U.S. screening laws and Beijing's own capital controls. How does a nation that spent half a decade pulling its money out suddenly pledge the largest single-country investment in modern history? Even by Washington standards, the math didn't add up. Treasury Secretary Scott Bessent saw something else. He reportedly told colleagues, according to a Wall Street Journal account from September 2025, that the offer might not be about the money itself, but about who sets the terms of the next financial order. If Beijing writes the first check, he warned, it writes the rules. Trump listened, jaw tight. The pitch arrived just as the U.S. was on what Bloomberg called a global shakedown tour, chasing capital from Japan, South Korea, and Europe to stabilize treasury demand. Tokyo had committed roughly $400 billion, Seoul about $300 billion, but neither wanted to pay in cash. Loans, not transfers. Europe promised 600 billion euros, but Brussels couldn't confirm where the money would come from. The West was pledging smoke. Meanwhile, Beijing's calculation looked colder. By early 2025, China had become the largest source of global foreign direct investment again, overtaking the United States with $163 billion in outward FDI, according to IMF data. Yet, almost none of it flowed west. Instead, it went south, into Brazil, Saudi Arabia, Indonesia, and the UAE, all BRICS members or recent invitees. In May 2025, Reuters reported that China and Brazil formed a $1 billion bilateral fund focused on infrastructure, agriculture, and artificial intelligence. The money would come from the China Exim Bank and Brazil's BNDES, targeting projects that use Chinese suppliers. Every yuan cycled back into Beijing's manufacturing base. That model stands in direct contrast to the U.S. approach. Washington has been urging allies to fund its reindustrialization through programs like the Build America Bonds 2.0 initiative. But Europe's investors balked at U.S. tariffs on steel, cars, and solar components. As the Financial Times reported on August 19th, the EU's investment pledges remain conditional on tariff relief that has not materialized. The contradiction was glaring. America wanted foreign cash, but not foreign goods. For China, that paradox became an opportunity. Back in Beijing, the National Development and Reform Commission publicly discussed a new 1 trillion yuan. That's about $138 billion. Venture capital guidance fund to channel money into strategic industries like semiconductors, clean energy, and quantum tech. Reuters confirmed the plan on March 6, 2025. The timing wasn't random. Just weeks later, Chinese negotiators hinted that they could extend capital access to U.S. ventures if reciprocal conditions exist. Translation: remove security blocks, and the funding door opens. Was the $1 trillion number a real commitment, or a signal that Beijing could choose where to send its surplus next? The geopolitical context adds weight. BRICS expansion in August 2025 brought in Saudi Arabia, the UAE, Egypt, Ethiopia, Iran, and Indonesia, covering nearly 45% of global oil output and 37% of global GDP at purchasing power parity, according to IMF World Economic Outlook data. Together, these economies agreed to coordinate new investment flows through the New Development Bank's Guarantee Fund, confirmed by Reuters in July 2025. The fund's mandate reduced borrowing costs for BRICS projects by providing sovereign guarantees, effectively replacing G7 credit insurance mechanisms. If successful, it could shift hundreds of billions in capital formation away from Western lenders. Inside the Oval Office, National Security Advisor Robert O'Brien raised the obvious issue security precedent. The Committee on Foreign Investment in the United States, or CFIUS, had already blocked Chinese acquisitions like Ant Financial's 2018 bid for MoneyGram and a 2022 mining project in Texas. Even with Trump in power, the institutional resistance to Chinese capital was deep. So why would Beijing float a number that U.S. regulators could never approve? Some aides suggested it was psychological, to make allies question America's credibility. If China offered what Japan and Korea refused, Washington's desperation would be visible to the world. Then came the energy dimension. According to the International Energy Agency's 2025 report, AI data centers could consume 4.4% of global electricity by 2035. The United States leads in AI capacity but faces power constraints. China leads in generation capacity, from coal to renewables. If Chinese capital financed U.S. AI infrastructure, Beijing could indirectly control the world's next power-hungry industry. It's an extraordinary hypothesis, and one U.S. officials quietly fear. Because unlike oil, electricity grids can be designed with embedded dependencies, chips that need Chinese parts, turbines that need Chinese maintenance, software that needs Chinese cloud licenses. Meanwhile, Brazil's coffee and soybean exports to the United States were collapsing under new 50% tariffs announced by Washington in August, as reported by Bloomberg. Within days, China approved 180 Brazilian coffee exporters to sell directly into its domestic market. The signal was unmistakable. When the U.S. closes a door, Beijing opens a gate. The shift isn't theoretical. Brazilian coffee shipments to China jumped from 130,000 bags in 2020 to 1.3 million in 2023, according to Brazil's Coffee Exporters Council. Multiply that pattern across soybeans, beef, and lithium, and a clear picture emerges. BRICS isn't just diversifying trade, it's absorbing the fallout from U.S. protectionism. Let's pause here. If Beijing can weaponize openness, offering access where Washington withdraws, then the trillion-dollar pledge could function as a global message rather than a bilateral deal. It tells developing nations, we have surplus capital, America needs it more than you do. In optics, that matters. The United States once defined the world's safe investment zone. Now it appears to be the one seeking foreign safety nets. But there's another interpretation. According to Goldman Sachs research quoted by the Wall Street Journal on September 15th, United States capital inflows from allied nations fell 22% year over year in the first half of 2025. Treasury yields briefly touched 5.1%, the highest since 2007. $1 trillion of Chinese capital, even hypothetically, would stabilize those markets overnight. So, markets respond not to the authenticity of the pledge, but to its symbolic reassurance. That could explain why the rumor alone boosted the Dow Jones by 3% and trimmed bond spreads in a single day. Beijing didn't need to send money. It only needed to move expectations. The midway question becomes unavoidable. What if the real goal is perception? If Washington welcomes the idea, China appears indispensable. If it rejects it, Washington appears isolated. Either way, Beijing wins the narrative. It's a strategic move reminiscent of its 2015 AIIB launch, inviting United States allies first, then letting American refusal frame the story as Western retreat. Neutral observers might call it policy judo, use the opponent's momentum against him. At the same time, domestic Chinese policy supports this posture. The State Council's July 2025 circular urged firms to expand investment cooperation under multilateral frameworks, language directly referencing BRICS. In practical terms, that means channeling capital through vehicles the United States cannot easily sanction. The new development bank's assets already top $50 billion, with China's voting share at 39%, Brazil's 15%, India's 14%, and the rest distributed among members. By creating an institutional ecosystem parallel to the G7's, China reduces the need to seek United States approval at all. From Washington's vantage, that's the nightmare. $1 trillion pledge that doesn't even need to materialize could still weaken Western unity. Because if Beijing can promise that amount publicly, Tokyo, Seoul, and Berlin must answer an uncomfortable question. Why can't they? In global finance, credibility is currency. When China writes a hypothetical check, it draws on that currency, confidence, and Washington's balance drops. By October 2025, multiple agencies were already downplaying the claim. The U.S. Trade Representative's office called it unverified speculation, while the Chinese Foreign Ministry labeled the reports misinterpretations of diplomatic language. Yet both sides allowed the rumor to linger. That suggests utility. Each government benefits from the ambiguity. Trump's team projects financial magnetism. Beijing projects leverage. It's diplomacy through rumor. A negotiation waged in headlines. Beyond the political theater, the material landscape is shifting. IMF data show that developing economies received $1.6 trillion in total investment inflows in 2024, surpassing advanced economies for the first time. Of that, over 40% originated from BRICS sources. If that trend holds, the G7 could lose its dominance over global capital flows within 5 years. The trillion-dollar headline then becomes less about one deal and more about signaling which world will finance the next one. So where does that leave the United States? Desperate for liquidity but unwilling to concede control. As FT columnist Martin Wolf warned in August, when a hegemon borrows from its rival, it mortgages influence as well as debt. The White House now faces that dilemma in real time. Accept Chinese capital and risk strategic dependency, or reject it and risk market instability. Each path carries cost. Neither restores supremacy. By the end of that tense day in Washington, Trump's advisors agreed on one thing: they needed Beijing's readout. Until then, the trillion-dollar pledge remained both lifeline and trap. Outside, markets rallied on rumor alone. In Sao Paulo, Brazilian officials toasted new BRICS funds. In Shanghai, engineers worked overnight on servers for Brazil's new data hubs. Across continents, the flow of capital was already redrawing borders, quietly, efficiently, irreversibly. And as the sun rose over the Potomac, one question lingered above the noise. What happens when the world's largest economy becomes the one waiting for investment to arrive? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.